If I had simply invested in a global index fund like the MSCI World ETF instead of chasing alternative investments, I would be almost 600,000 richer today. In this video, I'll share the investing mistakes that cost me that growth and how those lessons completely reshaped my retirement strategy. In my early 30s, as a young parent just starting to build my equity portfolio through unit trusts, I wanted to diversify beyond equities to reduce risk. What I didn't realize then was that I was actually building a collection of illiquid and opaque investments. Over the next decade, we dabbled in land banking, bought an overseas property, and invested in private deals, all of which, as you'll soon see, turned out to be costly mistakes. Mistake number 1. Investing into land banking. We were introduced to land banking schemes marketed as low volatility, asset-backed investments promising attractive capital gains once the land was developed. We invested twice, once in 2008 and again in 2010, totaling $56,000. The projected exits were supposed to happen within 8 to 12 years, but fast forward 17 years later, we are still waiting. Only one project now looks set to exit next year, with a disappointing compounded return of less than 2% per year. If we had simply invested that same $56,000 in a global index fund like the MSCI World, for my example, I'm using the SWDA ETF, with no FX impact, this amount would have grown to over $280,000 today, a gain of more than 400%. Instead, this investment tied up all our funds for years, offered no liquidity, and generated no cash flow. Truly a costly lesson. Mistake number 2. Investing in overseas property. In 2011, we invested $99,000 in an overseas property, hoping to benefit from both capital gains and rental yield. The amount was paid in full with no loan involved. Unfortunately, the rental income turned out lower than expected, and the resale market proved illiquid and opaque. To make things worse, the strong Singapore dollar has since led to nearly a 30% foreign exchange loss. Overseas assets also complicate estate planning, as they cannot be easily covered under a Singapore will. Once again, if that same $99,000 had been invested in a global index fund, like the MSCI World, using the SWDA ETF as an example, it would have grown to over $400,000, a 320% gain instead. Mistake number 3. Private investments. In 2019, we invested $45,000 into a private investment opportunity, hoping for multi-bagger potential, but without doing much due diligence work. That capital, today, is most likely gone. Had we invested that sum into SWDA ETF again, it would have doubled to $90,000 today. All these investments, as mentioned, have 3 fatal flaws. On paper, they seem unrelated to equities, but in reality, they share the same hidden traps. Number 1, they are all illiquid and locked up my capital for years, preventing me from responding to better investment opportunities. Number 2, they provided a false sense of diversification. In actual fact, they shared a common trait. They all didn't compound after all these years. And number 3, they come with high friction costs, including transaction fees, property tax, agent fees, foreign exchange exposure, etc. If those same amounts from the 3 mistakes had gone into the MSCI World ETF, no market timing and no leverage, that $200,000 would have compounded to around $790,000 today, and that's an opportunity cost of almost $600,000. Documenting and sharing these painful investing mistakes is truly a walk down memory lane, and not always a pleasant one. But I'm doing it in the spirit of sharing, so that you don't have to make the same mistakes I made. As the saying goes, the cheapest way to learn is from somebody else's mistakes. So, if this video has been helpful, please give it a like. It helps more people discover my content, and let me know that my walk down memory lane has brought value to you. And what's my biggest takeaway from all these mistakes? Diversification only works if it's liquid, transparent, and easy to value. Liquidity means I can rebalance and respond to market opportunities. Transparent means I can understand what I own, how it's valued, and what are the costs involved. Finally, the biggest lesson is that simplicity can compound quietly. Time in the market is more important than trying to time the market, but only if you are in the right market. As I shared in my video on how I 11x my net worth in 14 years, step 3 is to invest wisely and consistently. Automate the process and use low-cost index funds or ETFs and let compounding do its magic. So, check that video next if you haven't seen it. Even within public equities, behavior can make or break returns. My mistake number 4 was in concentration risk. Back in 2021-2022, my top 4 holdings made up about 70% of my entire portfolio, with the remaining 9 stocks sharing the other 30%. And when the market corrected in 2022, my portfolio plunged by more than 50%. And here's a not so fun fact. That drawdown alone could have fully paid for a central HDB flat in cash. Conviction is important, but conviction without diversification is dangerous. Fast forward to today, as an early retiree without active income, I can no longer afford sharp drawdowns, nor do I have decades ahead to recover from them. As of my most recent decumulation update in September 2025, my portfolio now holds more than 30 global and Singapore listed stocks, diversified across sectors and geographies. My top 5 positions made up less than 40% of the portfolio, and my top 10 under 60%. I still believe in long-term compounding, but now I diversify to stay in the game. The last mistake I want to share in today's video is this. I didn't take profits or rebalance when I should have. In 2021, valuations for some of my holdings were clearly stretched, but I didn't trim. I was following Warren Buffett's principle of buy and hold. When markets corrected in 2022, I held through the full drawdown. I didn't panic sell, but I rode the entire roller coaster and watched multi-bagger gains disappear. That experience taught me an important lesson. Buy and hold doesn't mean buy and ignore. Selective profit-taking helps me rebalance, manage risk, and rebuild my war chest for the next opportunity. In my earlier years, while building my career, I had limited time and insufficient financial knowledge. That led me to invest in alternative assets and manage my stock portfolio with less focus, resulting in painful lessons and almost $600,000 in opportunity costs, not to mention the emotional roller coaster of equity investing. Now that I'm retired, I finally have the time to dive deeper, to read reports, follow markets, and study opportunities calmly, something I simply couldn't do during my 9 to 5 years. I still enjoy managing my own equities, a diversified basket of over 30 global and Singapore listed stocks across sectors and geographies. It's active management, but done with structure, diversification, and discipline. My liquidity cash bucket covers 1 to 2 years of expenses, giving me peace of mind to ride out market downturns. My war chest lets me deploy capital when valuations become attractive. And over time, I can always shift more into ETFs if I want less active involvement. That flexibility keeps my plan sustainable, active now, passive later, but always by choice and not by default. Investing isn't about doing more. It's about doing what aligns with your time, energy, and Ikigai. In summary, we have all made investing mistakes, and each one becomes a lesson that shapes how we grow. I've shared mine today, but I would love to hear from you too. What's one investing mistake that taught you an important lesson? Share it in the comments. Your story might help someone else avoid the same pitfall. And if you found this video useful, give it a like and share it with someone else who's still on the investing journey. Every bit of reflection brings us one step closer to smarter, calmer investing. And if you would like to follow along my journey from FIRE to purposeful living, hit subscribe so you won't miss the next update. Till then, as usual, have a great Ikigai day.